The most common mistake novice traders make is analyzing a stock in isolation, treating its price action as a unique, self-contained event. They focus intently on a single company's earnings report or a specific chart pattern, oblivious to the powerful currents moving the broader market. This narrow focus creates low-probability trades, where breakouts often reverse prematurely and capital becomes trapped in stagnating positions. Jesse Livermore, the legendary speculator, understood that such isolated analysis was a guaranteed path to failure, recognizing that the market is a cohesive ecosystem, not a collection of independent charts. He demanded a mandatory initial screen for every trade idea, a filter that instantly eliminated 90% of the noise. The group action principle. This principle dictates that sustained success in speculation comes only from riding the momentum of an entire industry, not the whim of a single stock. Before we dive deeper into Livermore's methodology and uncover the specific metrics he used to identify group strength, please take a quick moment to help support the channel. If you find this exploration of timeless trading principles valuable, subscribe now and leave a comment below. Even a simple word or phrase about your biggest trading challenge is perfect. This simple action significantly boosts the video in the algorithm, helping ensure this critical knowledge reaches the traders who truly need it, and shows me that this type of detailed historical content is worth the immense effort required to produce it. Furthermore, remember this channel is always here for you. Please return during those challenging periods when trading becomes difficult and your confidence starts to waver, as these historical lessons often provide the necessary anchor. Livermore's strategies are designed to provide clarity during chaotic times, and your engagement ensures that this resource remains available to everyone seeking to trade intelligently. Stocks simply do not move in isolation. They are driven primarily by sector-wide sponsorship and sweeping economic themes that affect all participants equally. A powerful, sustained upward trend in a single equity requires massive institutional conviction, and that conviction is rarely confined to just one ticker symbol. When major money flows into a sector, it is attempting to capitalize on a macro shift, such as new government regulation, technological disruption, or a fundamental change in commodity pricing. Therefore, any stock showing exceptional strength must be viewed through the lens of its peers, confirming whether the move is idiosyncratic noise or genuine market rotation. Ignoring this context is like trying to sail a small boat against the tide of the entire ocean, resulting in exhausting effort for minimal gain. The group action principle serves as the definitive acknowledgement that market sponsorship, the institutional backing necessary for a major move, is always applied broadly across an industry before it concentrates on the leader. The requirement for a truly major, profitable move is straightforward. The strength displayed by your chosen stock must be preceded or immediately confirmed by congruent strength across its entire industry group. If your stock is breaking out of a long consolidation pattern, but every other major player in that sector remains subdued or is trending downward, the probability of a false move approaches certainty. Institutional traders who move the market with their volume seek liquidity and diversified exposure across a theme, meaning they buy multiple stocks in the same sector simultaneously. This coordinated buying action generates the necessary momentum and depth to sustain a price advance over months rather than days. A genuine market theme is inherently broad, and its execution by large funds must also be broad, creating the observable phenomenon of group action. Defining a strong group is the crucial first step in applying Livermore's filter successfully and moving away from single stock fixation. A strong group is an industry sector where multiple diverse stocks are displaying clear congruent strength, moving in the same upward direction. This means observing several major components breaking out of their respective consolidation bases, achieving new multi-month highs, or demonstrating superior relative strength compared to the general market indices. It is not enough for 2 or 3 minor volatile names to surge. The conviction must be visible in the established liquid leaders of the sector. The consistency of this collective price action provides irrefutable evidence that institutional capital has begun to deploy massive funds into that particular economic area. This observable congruence confirms that the underlying fundamental narrative, whatever economic or technological factor is driving the theme, is robust enough to attract serious, sustained investment. When a sector exhibits this collective strength, it is essentially signaling that the market has collectively agreed on the direction and value of that industry's future prospects. The group action principle transforms the selection process from a search for the single best chart into a systematic identification of where the largest, most powerful money flows are currently residing. By focusing only on these confirmed strong groups, the trader automatically aligns their capital with the path of least resistance and the highest probability of follow-through. This discipline prevents the emotional attachment to an isolated stock story and enforces a reliance on objective, sector-wide momentum. Livermore recognized that even within a powerful group, a single stock's breakout might be fleeting or misleading, perhaps driven by short covering or temporary news. Therefore, the group action principle needed a concrete, measurable confirmation metric to separate genuine sector conviction from mere volatility. This necessity led to Livermore's operational standard, the three-stock rule. The principle states that a breakout in a single stock, no matter how compelling its chart appears, is unreliable without external validation from its peers. Trading based solely on that isolated event introduces unnecessary risk and dramatically lowers the expected value of the setup. The specific metric demands rigorous portfolio selection. Before committing significant capital to a stock, at least 3 other distinct stocks within the same industry group must exhibit clear, technical signs of strength. These signs include breaking out of well-defined bases, confirming multi-year highs, or demonstrating a significant persistent increase in volume accompanying price advances. The three-stock confirmation serves as the ultimate validation that the group momentum is not merely localized excitement but a generalized shift in institutional preference. This metric provides the necessary objective evidence that the underlying economic theme is broad enough to justify a major speculative position. Using the three-stock confirmation is essential for distinguishing true industry rotation from localized noise or a brief speculative surge. If only 1 or 2 stocks are moving, it might be due to a merger rumor, a specific product announcement, or simply a temporary flow of retail money. True rotation, however, involves the coordinated movement of dozens of names as major funds rebalance their sector weightings across the board. The threshold of 3 confirmed peers acts as a high-pass filter, ensuring that the trader is only participating in themes that have achieved significant critical mass and institutional consensus. This systematic approach forces the trader to prioritize macro-level conviction over micro-level chart reading. This disciplined approach ensures that the trader is never relying on hope or a single company's narrative, but rather on the observable, quantifiable actions of the largest participants in the market. The three-stock rule provides a powerful, practical tool for market scanning, directing the trader's attention immediately to the sectors where the highest probability setups reside. By adhering to this strict standard, a speculator avoids the temptation of chasing isolated moves and instead waits patiently for the market to clearly signal where its institutional conviction truly lies. This patient confirmation process is a cornerstone of professional speculation, maximizing efficiency and minimizing exposure to erratic, unconfirmed movements. It is crucial to understand that the principles of market structure and institutional accumulation that Livermore used were further formalized and taught by contemporaries like Richard Wyckoff. If you are serious about mastering the foundational mechanics of how supply and demand drive price movements, particularly through cycles of accumulation and distribution, then you must explore the Wyckoff methodology. We have a dedicated channel focused entirely on the deep study of Richard Wyckoff's trading methods, offering comprehensive analysis of these critical market cycles. This resource provides the rigorous framework necessary to understand the institutional fingerprints that create the group action Livermore identified, helping you identify exactly when these powerful sector rotations are beginning and ending. Do not just watch the price. Understand the forces moving it by delving into the Wyckoff channel. The link is readily available in the description below this video. Once the strong group has been identified and confirmed using the three-stock rule, the selection directive becomes clear and unforgiving. The group action principle demands trading the single stock that is demonstrating the most strength, not the cheapest, the most familiar, or the one that appears to be lagging. Trading success is fundamentally about following the line of least resistance, and within a strong group, the leader is paving that path with the greatest momentum and institutional interest. This selection process moves beyond simple identification of a good sector and focuses on maximizing the potential rate of return and minimizing the time. Capital is tied up in slow movers. The leader is the stock that will invariably deliver the most substantial profits when the sector theme plays out. The criteria for identifying the genuine leader within a confirmed strong group are specific and measurable, demanding objective observation rather than subjective preference. The true leader is the stock that breaks out first from its base, signaling institutional anticipation ahead of its peers, and it is the stock that moves the furthest following the breakout. Furthermore, the leader is the stock that holds its gains most resiliently during minor market corrections, demonstrating superior relative strength and an unwillingness to relinquish premium pricing. These observable characteristics confirm that this particular company is receiving the greatest concentration of sponsorship and is the most sensitive instrument for playing the underlying sector theme. Trading the leader maximizes reward potential because the leader benefits disproportionately from follow-on institutional money and pervasive media attention. When a sector theme begins to gain traction, the highest quality, most recognizable name, the leader, is the one that analysts and financial news outlets spotlight first. This positive feedback loop draws in secondary waves of investment, often from less sophisticated funds or retail investors, further accelerating the price advance of the already moving leader. By focusing on the undisputed champion of the group, the speculator capitalizes on the highest velocity of institutional flow and the strongest psychological momentum. The leader is often the stock with the best fundamental story, the strongest balance sheet, or the most unique competitive advantage within the sector, justifying the institutional preference. While Livermore focused primarily on price action, he understood that the price was merely the observable effect of superior underlying fundamentals and management execution. The stock that is leading the charge is effectively the market's consensus pick for the best vehicle to express the sector theme. Choosing any other stock is accepting a suboptimal return profile, knowingly settling for less aggressive growth than the market is clearly offering through the genuine leader. The leader is also the safest trade in terms of capital efficiency, despite often appearing expensive compared to its peers. Because the leader has the highest institutional conviction, it typically experiences cleaner, more directional moves with less destructive volatility than the laggards. This predictability allows for tighter risk management and ensures that the capital employed is working harder and faster than it would be in a sluggish follower stock. The group action principle thus serves as a mandate for trading quality and conviction, ensuring the speculator is always positioned in the strongest possible vehicle. The Laggard trap is perhaps the single greatest reason why average traders, even those who correctly identify a strong sector, end up trading the wrong stock and achieving mediocre results. This trap involves the common psychologically appealing mistake of buying a stock in a strong group that has not yet moved, hoping to catch a cheap ride or anticipating a catch-up move. Traders often rationalize this choice by saying, "This one hasn't moved yet, so it has more room to run," falsely equating low price movement with high future potential. This is a profound misreading of market dynamics and institutional intent. The inherent weakness of the follower or laggard stock is multifaceted, primarily stemming from a lack of necessary institutional sponsorship or fundamental strength compared to the leader. If the sector is genuinely strong and large money managers have reviewed all the available names, the fact that a specific stock has been left behind is a damning judgment on its quality. Laggards often suffer from inferior management, poor debt structures, or a lack of the specific catalyst that is driving the leading names. They are the weakest links in the chain, and institutions know this instinctively. Consequently, attempts to trade these laggards often result in frustrating outcomes, false breakouts that immediately reverse choppy and non-directional action, or a complete failure to follow through on the group's momentum. While the leader is advancing 10%, the laggard might struggle to break out of a 1% range, absorbing precious time and capital. The laggard requires the general market theme to become overwhelmingly powerful just to achieve a modest move, whereas the leader moves aggressively on even moderate sponsorship. This differential in required momentum highlights the inefficiency of trading anything but the leader. The consequence of betting on low momentum is capital stagnation and exposure to immediate reversals when the group action pauses or corrects. When the sector takes a breather or the general market experiences a minor pullback, the laggard is always the first stock to falter and the last to recover. Since it lacked the deep institutional commitment of the leader, the laggard is quickly sold off, often returning to its base while the leader simply consolidates at a high level trading. The wrong stock means the speculator carries all the risk of the strong sector theme without enjoying the full benefits of its powerful momentum. The laggard represents capital inefficiency because the opportunity cost of holding a stock that barely moves while others surge is enormous. A speculator's primary resource is not just money but time, and tying up capital in a non-performer is a tactical error that prevents redeployment into genuinely strong setups. Livermore's philosophy demanded that every dollar be placed in the highest probability, highest velocity opportunity available, which inherently excludes the slow-moving, unconfirmed laggards. The temptation of buying cheap is the psychological hurdle that separates the consistently profitable speculator from the perpetually frustrated one. To implement the group action filter successfully, the trader must adopt a systematic, top-down approach that completely reverses the typical retail focus on individual charts. The process begins by identifying the strongest groups in the market, scanning broad sectors for signs of congruent collective price strength and accumulation. This step eliminates the vast majority of stocks immediately, focusing the analytical effort only on areas where institutional conviction is clearly present. This is the stage where the macroeconomic themes are translated into observable market action. The second critical step is to confirm the strength of the identified sector using Livermore's pragmatic three-stock rule. The trader must verify that at least 3 distinct liquid stocks within that group are displaying undeniable signs of technical breakout or superior relative strength. This confirmation ensures that the observed momentum is broad and sponsored, not merely a flash in the pan or a localized event confined to one company's news cycle. If the 3-stock rule cannot be satisfied, the entire sector must be discarded, regardless of how promising the first stock appeared. Finally, and most importantly, the trader must select the strongest leader within that confirmed and validated group. This selection is based purely on relative performance. Which stock broke out first, which stock is moving fastest, and which stock is holding its gains most aggressively. This is the moment where the speculator aligns their capital with the highest quality vehicle that the market has unanimously designated as the champion of the current theme. The discipline of trading, only the leader is non-negotiable for maximizing returns. The ultimate goal of the group action principle is the ruthless filtering out of 90% of potential trades by focusing exclusively on high-probability setups, supported by powerful, verifiable sector momentum. This principle acts as a defense mechanism against emotional trading, preventing the speculator from falling in love with a particular stock or narrative that lacks institutional backing. It transforms the speculative process from a subjective search for isolated value into an objective process of following established money flows. By focusing solely on groups that are moving, the speculator ensures they are always positioned in the most favorable market conditions. Trading success is fundamentally not about finding the cheapest stock or the one with the most compelling story told in isolation. It is about following the strongest institutional money flows as evidenced by congruent group action. The market is constantly signaling where the conviction lies, and the group action principle provides the map and the methodology to read those signals clearly. Adhering to this filter ensures that the speculator is always riding the tide of institutional sponsorship, maximizing efficiency, and dramatically increasing the probability of achieving major speculative profits. Never trade a stock that is moving alone. Always trade the leader of a confirmed strong group. For those dedicated to mastering the wisdom of Jesse Livermore and truly understanding the psychological and strategic depth behind his market actions, there is no substitute for the foundational text that chronicles his life. We highly recommend the new edition of Reminiscences of a Stock Operator by Edwin Lefebvre. This classic offers an unparalleled, deep analysis of Livermore's psychology, his strategies, and his disciplined approach to speculation, including his development of the group action principle. This modern edition is enhanced with unique commentary and detailed breakdowns for every chapter, transforming Livermore's historical experiences into practical, actionable lessons for today's sophisticated traders. It is the essential guide to understanding the mind of the master speculator, offering insights into market timing and the necessary emotional control required for success. Do not just read the story. Study the lessons by picking up your copy today. The link is in the description below.